Let's continue. Kila Alumi, current ordinary dividend cover computed based on the above draft account is 4. Preference dividend is fully paid. We'll come back to that. A comparable quoted, we are done. So let's complete with the net asset situation here. So help me out, the current asset situation. What do we have for the absolute?
148,900.
148. Are you sure?
Oh, you mean the current asset or the?
Yes, please. The
adjusted?
current asset, so that I will take that to the, then we'll do all the amount.
34,900.
900. Okay. So now give me the 3. So we get. Would that be? Hold up. I'm coming. Give me a moment. Have we touched on everything? Because you always want to know whether you've touched on everything, right? We've brought properties, we've brought a plant, and we just brought the current asset. So now total asset, what are we getting?
148,900.
Okay.
Confirmed.
All right. So that's our total assets. Then you know what we are going to do, right? We less liabilities. Fortunately, there is nothing in the notes that requires us to adjust any liability. So we're going to pick whatever the heck we have there. First, the current liabilities, 15,420. So current liabilities, 15,420. What else we got? Do we have? Yeah, we have non-current liability. So non-current liabilities. How much we got? 38 and 80. Then, can you see preference shares here? You know we said for tax purposes, did I say for tax purposes? For business valuation purposes, it's a liability, right? So although it is under equity, it's a liability, and that is 6,000. We're going to bring that also up. So give me the 3. Let's see what we got.
So we have 59440.
59440. So we take it out from the total asset to give us the net asset.
89,400.
That's 89460.
89. I'm hearing 400 somewhere. I'm hearing 460 somewhere. Who is right? Who is wrong?
I had 400.
Okay. Who is having the 460? Did you make an error somewhere? So this is our net
Sure,
asset.
I have to look at it.
I have to look at what?
The net asset figure.
Liability.
It should be what?
59,500
rather.
Supposed to be 89460,
Yes,
not
4. Relax. So what should I write here? 59 what?
440.
500.
Oh, Obi say 500, Obi say 440. That's same crania. Who is wrong? Who is right?
It's
59,500.
59,500. Okay. All right. So 440, please punch again. It is 15,420, 38 and 80, and then 6,000. So will that now give us the net asset to be 89,400?
Yeah, that's correct.
Okay. So that's our net asset. Remember, you are doing all this in 27 minutes. So speed and accuracy, right? Now we need a number of equity shares. Okay. So you can see we are told here, ordinary shares are $2 each. Sorry, 2 Ghana cedi each. So take me to probably Workings 2 here, number of equity shares. And that is going to be 24,000 divided by 2. What do we have?
12,000.
12,000. There we go. So now we can calculate the value per share, which is the requirement of the question. So value per share. Our net asset, 89,400, divided by the 12,000. What we got?
7.45.
7.45. That's the answer to the A aspect of the question. So those of you who were bringing some 1/3 something, where was that coming from? Any questions?
Hello, sir.
Yes, Da.
Nhyira, please, I have a question to ask.
Hold up.
In respect
One.
of the,
Let's go. Who is this?
can I proceed?
Yeah, go.
Okay, so in respect of the preference shares that we added to the total liabilities before we deducted, assuming in this case it is irredeemable preference shares, assuming we have redeemable preference shares, do we still add it to the liabilities and deduct from the total assets?
Whether it is redeemable or irredeemable, it is a liability for business valuation purposes, right? So we will bring it up still if it is redeemable.
Okay, so when you want to adjust the profits,
Mm-hmm.
I understand you deduct the preference shares. In this case, is
Hold
it
up,
redeemable
hold up,
or
hold up, hold up. So we'll get there. So hold that
Okay.
thought so that when we get there, then you will bring it up. Okay? All right. Yes, Henry.
So the reason why I was doing the 1/3 was when they said he had a third of the investment that he wants to sell off.
Yes, but then you see, this is value per share. So the whole net asset is 89,400. Would you agree that that is the total value of the equity of the company? So their 1/3 will rather be like this. If we are calculating the share, their value for the 1/3, it will be like this. Or the
Oh, okay.
7.45 multiplied by 12,000 divided by 3. It will still give us what? The investment that KCVG has in Kilalumi Limited. So that's the workflow. That's the workflow. Here, and that clarity is important because as I said, here we are not supposed to calculate the value. The requirement of the question didn't say we should calculate the value of their 1/3. The question said we should calculate the value per share. If the requirement had said calculate the value of their 1/3, then we would have gone this way. How much would this be? 1/3 of 89,400. How much would that be? Assuming we are doing that.
That'll be 29,800.
Good. So if the requirement of the question has said we should place a value on their percentage of ownership, then this is it. So the context of the question, the requirement, directs or determines how we work. That's the idea. Okay, let's go to the next one. PE ratio. So, let's go to PE ratio. So, price earnings ratio. What is the value per share here? EPS. Multiplied by the PE ratio of the proxy firm. And as we mentioned here, for some reason they said don't adjust, but let's calculate the earnings per share. Earnings per share is what? Profit attributable to equity shareholders. You write that in full, okay? Divided by the number of equity shares. Divided by the number of equity shares. So again, to the question that you asked, now we are coming there. So give me the adjusted profit now. Adjusted profit. I'm getting 14,720 as the adjusted profit. Okay, 14,720. Then we will less the dividend we paid to the irredeemable preference shares. Okay, how much is it? How much will be their dividend?
That's going to be 600. 10% of
10% of 6,000. Good. Now we can get the parties. Profit attributable to equity shareholders.
14,120.
Remember, I told you something when we were doing this thing that if we have redeemable preference shares, there is an assumption in the school of thought that the returns on them will come to the P&L, so might have already been adjusted for in arriving at the profit before tax figure. So you wouldn't come and subtract again if it is redeemable preference shares. But if it is irredeemable preference shares, then after the profit, you will subtract it. We clarified this during the lecture. And there is a question that really shows this up. I don't know if it is the Sasalisa question or something like that. There's a question like that. We'll solve it before you go into the exam hall. And in that question, there is redeemable preference shares, there is irredeemable preference shares, and that principle that I just mentioned again, you will see it at play. Okay, so parties 14, 4, 20. So let's come back. Give me something. 14, 4, 20. What is our number of equity shares? 12,000. What we got?
1.18.
1.18. Okay. Oh. Good. So now that you have this, you can now calculate the value per share, which is the requirement of the entity of the question. So 1.18 times the proxies firm's PE ratio is what? What does it say? 7.2. So we won't adjust because they said no adjustment should be made to these ratios. So let's go. 7.2. What do I have? 8.5.
Sir,
Ma.
the earnings per share is not 1.18.
What are you getting?
It's 1.2.
You are
I'm
running
getting-
it.
No, there is giving me 1.2 straight away.
So who is wrong? Who is right? It's 120 and pam. Mina mediegu. Forgive your teacher for oversight, which can cost you mark in the exam hall. Is it difficult? Like, what's the challenge here? Tell me. Like, let's talk. What's the challenge here? Like, really, honestly.
The point I'm making is that the challenge here is that one single mistake that you do or you commit here end up affecting everything. For example, with the receivable bit, I thought of it several seconds. I was like, okay, definitely you are going to receive it, so there's no bad debt. So I end up ignoring the bad debt implication on the income statement.
Okay.
And this will affect my earnings.
Earnings, yeah.
Yes. And then this earnings too is what I'll be taking for my dividend.
Dividend. So you are also in the Zokbo environment.
Exactly, sir.
We are
okay, so and
Charlie.
realize that if you miss any of the IFRS questions, like the investment properties, if you're not able to, get adjustment done right, then you end up messing up.
That's the thing.
But then generally it is not difficult. Generally it is not difficult. Yeah.
But those adjustments are the things that you just have to be mindful of. And these are the things that I want you guys to really look out for. Do you understand it? And it's not difficult. It's not. But you have to understand, like the judge's concern that, we will receive the money again. But you should have paid attention to the date when the money will come. So you realize that when I read the date, I went to ask, what is our year ended? Then I realized that, our year ended is 31st August 24th. So if the money will come 31st August 2025, that's in a year's time. Hence, it has to be discounted into present value. So that is the strategy. Looking at the question in its holistic manner, then you reach the conclusion. That's the thing. So let's get the last one, then we roll out. Dividend yield. What's the formula for dividend yield situation? Value per share equals what? Dividend per share over DY. So we need dividend per share. The DY, we will use the proxies DY, right? But they said we shouldn't adjust, so we're going to stick with that. But we need to calculate dividend per share. Now, we have finished reading the note, but we didn't find dividend per share. But the examiner gave us a clue, which we can use. So what's the clue? It says that, note 3, Killer Alumi's current ordinary dividend cover computed based on the above draft account is 4. Okay. So if I'm giving dividend cover, I can work my way back to get the total dividend. Then I can get the dividend per share. So we're going to work backwards. So stay with me. Let's go. What is dividend cover? Dividend cover equals the dividend attributable to the equity shareholders. Okay. So dividend attributable to the equity shareholders divided by what? Dividend paid to the equity shareholders. Stay with me. Stay with me. So if we go to the question, were we given anything like dividend paid somewhere in the question? Nope. The firm. Okay, so let's go. So this is the formula for the dividend share. May say cover dividend. What kind of school did you attend? So what are we making the subject? So we need a numerator, the dividend that will be attributable to the equity shareholders. Now, if you check, the entity made a profit here of 12,320 because they said the dividend cover was calculated based on the above. So you can't use the adjusted thing to work out. So we're going to assume here that the earnings or the profit for the year is going to come. So that will be our numerator. So that is 12,320. Then we subtract dividend to the preference shareholders, which George highlighted a moment ago, the 600. That then gives you dividend attributable to the equity shareholders. This is the principle in the takeaway that we spoke about, number 2, that dividend of preference shares must be considered in the calculation of earnings per share and dividend per share. So you saw that in the earnings per share workflow, we subtracted the preference shares dividend. In the dividend per share workflow also, it has to be subtracted. Principles. It doesn't change. It doesn't change. So let's divide by the dividend payable, which we don't know. So dividend cover is 4. So we get a dividend paid to the equity shareholders. So we do cross multiplication to get a dividend paid to the equity shareholders. And so what do I have from this and that? The numerator. 600 from
11,720.
11,720 divided by 4. Because the 4 will come and divide it. What do I have?
2,930.
2,930. Good. All right. So that's the idea there. 2,930. Okay. So let's now calculate. Now you have the dividend paid to the equity shareholders. But we are looking for dividend per share. So you can now calculate dividend per share, which is the dividend to the people divided by the number of equity shares. Is it still, is it 12,000? Yeah. Can I have an answer coming up, please? 0.2, what? I missed the other figure. 0.24, okay. Is that figure confirmed? So now that we have the dividend per share,
Yes, confirmed.
okay, we can calculate the value per share, which is 0.24 over the dividend yield of the proxy firm, 4.25%. This is purely ratio analysis. So, what do we have? I'm getting 5.4.
5.3.
3 or 4, yeah.
How am I getting 5.6?
It should be 5.3.
I'm getting 5.6. So
Or
is
5.65.
yeah.
I'm also getting 5.65.
So 5.34. No, what are you punching? Relax. Am I picking a wrong figure again? Oh, sorry. It is 4.52, not 4.25. Sorry. All this is part of the Zorkball situation. No? Go and pick a wrong figure. So the 5.4, what? George, your squat. 5 point what?
It's 5.3. No, 5.3.
3. Okay. Okay. That's it. Do this 15 marks. 27 minutes. What do you want again? So slide 1 in that
The more
regard.
grief to our own.
Definitely. Definitely. So slide 1 there for this. Slide 2. Slide 3, the dividend yield valuation and the workings we did to adjust the profit. So you see, I say this always. It's not just about how many questions you solve. I know there is a part of your brain that is telling you, I need to solve a lot of questions. I need to solve a lot of questions. Yeah. But you can solve 10 million questions. If the principles are still not with you, each of the questions you pick, you will not be able to succeed. So I really need you to grab the principle, especially the key takeaways that we highlighted on. Let this be by your side. This is your takeaway under business valuation. So when you pick any business valuation question, you know, I need to pay attention to the context of the question. I need to understand what is going on. You know, I must adjust PE ratio, DOI ratio, unless otherwise I'm told not to, like in this question. You must know how to deal with those other principles here. And that is what you need. Once you get the principles, when you see the question, you can apply the principles. It's not difficult. It is the principles and the application, which is lack of understanding of English language. And you know, I say that all the time, not that, as I say always, it's not like I'm disrespecting you like you don't understand English, but it's English. So that is it about that. We wrap up here today. And God willing, next week, we will see where else we can go. Susuka is a reconstruction question. We will come to it and see how we could use that as a guinea pig to also revisit financial reconstruction again, you know. Then the question 3, standards. Some serious issues there.